last seminar I talked about the strategy in terms of how to get to 10 properties in 10 months. The key would be the capital. You got to have the money for payments and reserves. It's not. There's no quick, easy way to make this happen. You know, there's not a secret way where you can buy 10 homes in 10 months by having $1,000 in your bank account. You have to have the capital. This has got to be your business. This is if you're serious about investing in rental properties for passive income, you got to make it your business. So you need to be able to start planning how much money you're going to save in order to strategically do this and make a living from it and eventually retire, which I think what most people's end goal is to use this passive income to create income for the rest of your life. So we'll talk a little bit about the strategy in detail in terms of how much money you're going to actually need in reserves and in capital to purchase 10 homes. Whether it happens in 10 months, if you have the money to do it, great. If it doesn't happen in 10 months and it happens in 10 years, I'm going to show you how much money you need on average when we look at some of these ARVs on the typical deals that I have been doing. And I'm going to explain to you about that process and we'll go over that. First things first, credit. How many in here know your credit score? Raise your hands. Okay, so how many in here know what the minimum credit score is to qualify for a conventional loan? You're a show-off. You can't be doing this. Yes, 620. But if you're 620 trying to buy an investment property, you're in trouble. 620 is the minimum you need to buy like a conventional primary residence, those types of products. But if you're looking to purchase an investment property and you're a 620 FICO score, it's going to be very, very difficult. You got to put 50% down. You're going to have a high interest rate, a higher cost, because the pricing is just not that advantageous for you. Now, if you are a 680 credit score is about where the pricing starts to get okay, and the down payment requirements start to get okay. 720 is the magic number. Why do you think 720 is the magic number? Don't answer. Does anybody know why 720 is the magic number? 720, why is it the magic number?
Well, with all the financing that you're going to be doing, you're going to be, the frequency of what you're going to be doing, you're going to be knocked down several points for each credit check. And so you want to be able to have an option for you to stay in this dynamic for all of that.
That's a good answer. Yes, that's a big part of it. The other part of it is if you're not a 720 credit score, you're limited to 4 financed properties. That's a big whammy. If you have a 718 credit score and you're trying to buy your 5th property, I can't do it for you without trying to get your scores up. 720 FICO score allows you to go to 10. And we're going to use the number 10 a lot because that's what Fannie Mae says you can acquire when you have a 720 credit score and up. You're able to acquire the maximum amount of financed mortgages on the conventional side, which is Fannie Mae, and that's 10. Yes?
Does that finance properties include your home?
It does.
Protected before.
Anything that is financed, homestead,
now it's
hard
just-
money loans, private loans, anything that carries a mortgage, whether it's private or it's conventional. If you're a below a 720 credit rating, your max.
Tilt it up a little bit so
And
you
that's
see the screen.
a big thing that you guys should keep, write
Just stop.
down and keep at the top of your head, is that you've got to be a 720. We're going to go over some things on that piece. So, how many people get a copy of your credit report? You guys have a copy of your credit report? By show of hands? How often do you get a copy of your credit report? Well, you can get a free copy every year, right? Every year you can get a free copy of your credit report. So I would advise that you guys do that if you don't. It's important to know what's on your credit. You want to know what trade lines are appearing on your credit. You want to know if anybody is reporting you derogatory. You want to know if the inquiries are on your credit that you didn't authorize. You need to know all of these things because it's important to know where you lie. Your credit score, the reality is we live in a credit-based society. It's not no longer the days when you just walk into a bank, shake somebody's hand, and your merit and looks are going to give you a loan. It's based off of what you have on your credit rating. That's what dictates pretty much everything. Sometimes you can't even get a job unless your credit is decent. I mean, it's, with credit checks and things of that nature, backgrounds, I mean, you have to go through that process to even get a job. So this is something you need to guard with your life because it's your lifeline. For investors, it's something that's your lifeline. It's just as important as having money in the bank. If people people in this office that know the tough ones, because I'm doing them now, or I've worked, or I've done them. So I may not necessarily always be the cheapest, but I bet you I'm going to be the best. So be careful with trying to go with people that you go to multiple different lenders to acquire properties. Try to find one that you know works well with you, knows your stuff. It also makes it easier for subsequent purchases because they have all your stuff already.
And time is money.
Time is money. You know, I've done several transactions just for Mr. Ball over here, and we run like this, don't we? You know, we run fast. He calls me up, I'm ready to move on. I get the next one, we're good to go.
So you're real competitive.
So we run fast, yeah, Chris.
You closed mine in 30 days, and when I went to go sign, man, they go, I can't believe you closed in 30 days.
But we closed actually in like 22 days.
22, yeah.
Yes, we move fast on that one. I've done, and I appreciate that, Chris. Thank you. Yeah, we close fast. We move fast. If you work with the lender that knows what they're doing, you know, we can move fast. And if you come to me and say, hey, I got a special situation, I got one right now. I got a contract on today that's got to close by the 12th of May. That doesn't give me much time, but I'll make it happen. I'll make it happen because A, I own the company, so I can kind of push it in line a little bit faster, and B, it's an important loan. So we got all loans are important. And let me give you an example. I did a $60,000 loan last month. That was the hardest loan I've ever done in my entire life. Literally, the most difficult transaction I've ever accomplished in my life. It took me like a week to just figure out this person's income. There's 10 different companies and all kinds of businesses, and everybody turned them down. Everyone turned them down because nobody wanted to take the time because it was a $60,000 loan.
Bar, like this thing right there.
So because of the person
Looks
that
like
the
that, but
referral
it
came
kinda-
from, and because I'm a glutton for punishment, I guess, I took the time,
some reason,
went
whenever
through it,
it
and
shows
figured
up
it
and it
out.
fills up.
Absolutely. And I figured it out, and I got it done, and I got Longhorn paid, because Longhorn was the investor on that side, and they needed to get their money, and they weren't getting it because no one could do the loan. So we ended up getting it done. But that's just a quick little side note. Deal with an expert, plug for me, plug for Jeremy, plug for two Jeremys actually. We are experts in our field, and we can help. Okay? Here's what we can do. Specialize in investor programs, hard money conversion to permanent financing, rapid acquisition of 10 properties. Again, when you're buying a property and you're going conventional, I can use the income that's being derived from that property that you're buying to offset your mortgage, called using projected rents. So like if the house is already being rented, or it can be vacant for that matter, we get what they call a 1007 or 1025 schedule on an appraisal. It tells you what the projected rents are for that property. Fannie Mae says I can use that at 75% to offset your payment. I did a loan for a guy that bought 3 fourplexes. He got turned down by every lender because his debt ratio didn't work because he was making $2,000 in a month in Social Security. But he had a 1031 exchange. He had like 200 grand in a 1031 exchange. He wanted to throw that money into 3 fourplexes. Nobody could approve them. I did them all at the same time with the same investor, and I was able to use the projected income on those properties to qualify. I closed 3 fourplexes for him. He created a $6,000 a month income for the rest of his life with 200 grand. Pretty cool. So we can do that. Properties without lease agreements or vacant, because we're going to use the schedule on the appraisal. Delayed financing to get cash out from your cash purchase to buy. So basically what that means is, if you use cash, and I've done this for some people that are actually in this seminar, if you pay cash for a property, I can get that money right out. Start the process the next day. It's called delayed financing. We don't have to wait the 6-month seasoning requirements to pull the cash out. To do it that way than for me to do a conventional loan, because you're going to pay less money out of pocket. Yes?
So when you do it that way, how long does it take to get the money back out so it can be used again?
21 days.
21 days?
21 days.
I'm going to ask you that outside of this.
Okay. 21 days for delayed financing, yes.
Why would that be better than the conventional?
Because think about it. So let me use the scenario that I just gave. If, let's say you have a house that's got an ARV of $150,000. If you bought a conventional loan straight outright, that's going to cost you about $30,000 for a down payment, right? If the purchase price, if the purchase price was, let's say $100,000 on a property that's worth $150,000 because it's dilapidated, right? Needs some work. 20% of $100,000 is $20,000, and then you got about $5,000 that you're going to have to put into a closing cost. So you're in for 25 grand. If the house needs $10,000 or so in repairs, now you're all in for $35,000. If you bought that house for $100,000 cash, but it's gonna be a situation where in that type of scenario, you're out of pocket, total out of pocket is much lower. You're all in at that point for maybe 10, 15,000 as opposed to 35,000. You know, and I mean,
Purchase price was 140, appraisal came in at 177, and 75% of that is 133 or something.
right. So basically, yeah, it was amazing. I mean, this situation, we did what?
Really good.
Very
You
good.
don't find that very often.
No, you don't, but his total buy-in, if you would have in a conventional loan, would have been 30, 40,000. He spent 10 grand or something on that property because he did delay financing, because he had the capital to put the money down to pay cash. So that strategy you can do to get to 10 finance properties very easily. So
The renter thing is important.
very much so, and we'll get into that piece. You have to have a renter in the property in order to offset the lease, if you need the income. If you don't need the income and you can qualify with the full payment, you don't need a renter. But if you need to use the income to offset it, you gotta get a renter.
So you have to wait till it's leased and if you need.
If you need the income, gotta wait till it's leased. So you wanna try to do it quickly if you need the income. And that's something that we would strategically decide and say, do you need the money to qualify? Well, then maybe delay financing is not the best way. Maybe we got to go conventional purchase because I'll be able to use projected rents without a renter being in it. But if you don't need it, then we just do the delay financing if you have the liquidity. Yes.
Go back, kind of.
These cameras made to be like
one
snapshot and video. Come on.
Just talking about. You know, if you're cash out,
Like, is it recommended to use or is it or just like short?
So you're saying if you pulled cash out of a property and then you paid that money in a 1031? Oh, I got what you're saying. So if you paid cash for the property and then you wanted to pull the money out? That's a good question. I don't know the answer to that, because I don't know the tax consequences on it. I know that the shelter for the 1031 is exactly what you want to do, but I don't know what the tax consequence would be if you wanted to pull then that money out. Because in a sense, what you're doing is you're, in a roundabout way, still accessing that money. So, yeah, my gut tells me that you probably would be, because you're still, if you pull that cash out, you're essentially just sheltering it, putting it into a property, and then cashing it right back out. I would say you might be subject to capital gains. I'm not a CPA. That would be something that you'd want to talk to your CPA about. Yes.
Two real quick questions. The first one is, does it matter if you buy the property personally or in an LLC?
It does. It matters. It does matter. Preferably, if you're buying delayed financing and you're going, you're talking about delayed financing?
Generally, investment property.
Yeah. If you want to put the you want to buy the property in your own individual name, and I'm going to get into that a little bit more.
One more quick question. Does Fannie care as far as geography, like where you buy? Can I buy a property in Waco, or do I need to buy?
No, they do care for, there's one specific thing that they do care about. They care about when you're buying multiple properties in the same neighborhood. They do. They care if you're buying a lot of properties really, really close together.
Why?
And I think a lot of that has to do with the fact that I guess all of your loans are with one general area. If something was to, if a natural disaster happened or a catastrophe happened, you're crap out of luck.
But see, I think that's a positive, the way I look at it, because I have 3 houses in the same area. I can control the rent in that area too.
Yeah, I mean, I don't
So
disagree.
they don't.
Yeah, I don't disagree with that, but I do know that that's caused problems in the past when somebody owns a lot of properties in a very close proximity using Fannie Mae financing. And I think it has a lot to do with the fact that the properties they're concerned in the event of a natural disaster. We gotta remember, they have, these actuaries that come up with these, reasonable or unreasonable things that could happen to a property, and these are one of those things that they come up with that could ultimately, could it happen? Possibly, very unlikely, but they do have an issue with that. You have to be careful about buying a lot of properties in one small area, because that could come up. Yeah.
The loan financing, sourcing the cash, is that an issue?
Of course,
Could you take it out of the home equity, not the top loan?
you can, but that's a good question, and you and I, let's talk about that. I want to talk to you about that. But the question was, if you pull that money out of a property as a home equity loan, could you use that cash to go buy another property? You can, and then do delayed financing. But if you used a loan from your property to go buy that, and that's where the money came from, that money that you get back from that, the cash out has to go back to pay back the loan you got the money from. You gotta replenish that fund with that cash. We'll talk, I'll elaborate more on that. But you can do it. The caveat is, though, you have to replenish the fund. So like if you used a revolving, let's say you had like a home equity line of credit that continues to revolve, and you had $100 grand and you went to go buy a house, and then you pull that money out. When you get that cash back, that money's gotta go back into that revolving line of credit. But you can continue to use it because it's a HELOC and it continues to revolve. So it really doesn't matter, but the money does have to go back to that fund. The only time it can go into your personal bank account is if it was your personal money. And it wasn't acquired to, you didn't acquire it from any type of loan, so to speak. But delayed financing is a very good product, and for those that want more information on it, just give me a call, we can talk afterwards. 85% LTV, we talked a little bit about that. It's not something that I recommend. If you have money to put down, put 20% down, you're gonna get a better rate. Okay, so we're gonna talk about the strategy. Here's where we're gonna spend a little bit of time kind of giving you the roadmap of how much money you actually need to acquire 10 properties, okay? So very important piece here that we'll go over. I'm going to talk about the method first. By using hard money for lower out-of-pocket up front, okay? You use hard money lending. Hard money lending is going to lend you up to 75% of the ARV, right? So if the property is worth $150,000, they're going to lend you $112,500. If the house is being sold for $100,000 because it's dilapidated and needs $20,000 in repairs, I'm going to get into how much money you need for that. But hard money is the best way to go up front, and then you can transition into what we call a hard money conversion loan. Hard money conversion loan is when I come in and I do the loan and get it out of the hard money. Because what's hard money? It's temporary financing. It's a bridge loan. It's not something that you're going to keep for a long period of time. And it's also going to be something that carries about a 14% interest rate. So you don't want to stay in that loan very long, but it's a necessary loan. Especially if you're in it for the long haul, you will use hard money. One time or another in your life, you will use hard money to buy property, unless you just get super lucky. But normally, hard money is the way you want to go. So do a hard money conversion loan. Have the renter ready to move in as soon as you close on the permanent loan, so we can offset the income so that you can continue to repeat the process. That's how you finance 10 homes in under 10 months. You just got to continue to repeat that process. You buy the house, you use hard money or conventional money. Hard money probably first if the house needs work. You do the hard money conversion loan, but before you got to get a renter in there so that you can offset the payment. Because I can use that income at 75% to offset the payment. So if you don't make enough money at your job to hold the note, the income from the property will help sustain it because it washes it out. So if the note is $750 and your rent is $1,000, I can use 75% of $1,000, which is $750. So what did that just do to the payment? It cleared it. It's like it doesn't exist. So you can continue to repeat that cycle over and over and over.
So
and
there's
over
no
and over.
seasoning required from when you first purchase the property with hard money?
With
Or
some-
you can do it like effectively cash
You can
out?
you can do a rate term refinance. You have a rate term refinance. You can do the original season. When you get the hard money, you can do it 30 days later.
Sounds like
There's
steep
some hard money
Which is not a good
that
number.
is seasonal.
You mean like if they have a prepayment penalty or something?
Well, I don't even think there's a prepayment penalty. I've met some hard money lenders that say you have to be in the loan for 6 months.
Got it. Yeah, and that wouldn't be a
You have
Fannie
to
Mae
be very
thing. That would be
careful.
a
Now,
hard
Longmore
money.
doesn't do that, but there are some that do that. You need to be careful of that too.
Yeah, that's a good point.
Because their
Fannie
rates
Mae
might be
doesn't.
better, but if you have to stay in it for 6 months, that don't make sense.
Agreed.
It doesn't make sense.
No, I agree. Fannie Mae doesn't have a requirement there in terms of the time frame. There's no seasoning on that. You can do the hard money. Now there is on cash out, but you can't do you wouldn't be able to cash out on that property until after 6 months, or if you did delayed financing, you can do it within 6 months right away. But hard money wouldn't come into play.
You can loan on 80% of the appraised value. which
On a
is
refi,
your-
it's 75%.
Text back to you.
On a refi, a conventional refi hard money conversion, you're subject to 75% of the ARV on a conventional refi. The 20% is only on purchase money. There's a difference between refinancing an investment loan and purchasing an investment loan. 75% max LTV when you do an investment refi, whether it's cash out or rate term. Okay? Yeah.
Just kind of like the scenario on, let's say, you purchase a house, put sign, borrow money from home for 90 days. in 6 that you have to prepare. You have to, because what it says is, as soon as you close the permit on the loan, they can actually begin under the hard money.
Yeah, absolutely.
That's really what it's about.
That's exactly what you want, because you want to have, and you don't even have to have them moved in. You just have to have a lease agreement with a security deposit and first month's rent. You have to prove that you received money, and then I can offset the payment.
That's only if you need them.
That's only if you need the money. If you make enough money on your wages or your self-employed income, if you need the money, you got to follow this strategy. You don't have to do this if you can qualify with the full payment. If you're lucky enough to have a fantastic, income and everything is great, you don't need to do this. But I will tell you, I work with a lot of investors, and there's only a handful of them that don't need it. Most investors need it. There's a reason why they need it, because they're sick of their 9 to 5, and they're not making enough at their 9 to 5, so they're buying investment property so they can retire. So that's a lot of times you're going to need it. Okay? So here we go. Here's a scenario on property 1, right? I'm going to give you a property value of $150,000 ARV. This is about average of what I've been seeing in the loans that I've been doing. Is this typical? It has been for me in terms of the loans that I've been doing. Okay? So we're going to give you a scenario of buying property 1, average ARV of $150,000. How much money you need? Use hard money to buy. Let's say the property is $100,000 purchase price because it's dilapidated, right? And I've done several of these in the past couple of months. And I'm using real-time scenarios, okay? $100,000 purchase price. It needs $20K in repair, okay? It's got $8,000 in closing costs because you're going hard money. Hard money is going to be usually anywhere from, 7 to 8% of your loan amount is what you're going to have with hard money cost. It's not easy, it's not pleasant, but it's something that is a necessary evil. Or $78,000, $9,600 in reserves. Here's where the reserves really come in. Because what happens after 4 properties? You have to have 6 months in reserves on all financed properties. So at 5, $97,500 in actual capital you need for down payments to acquire all the above. And then you need $24,000 in reserves for property 5. Property 6, $117K you would have spent for all 6 properties, $28,800 in reserves. $136,500 for 7, $33,600 in reserves. $156,000 for 8, $38,400 in reserves. $175,500 for 9, $43,200 in reserves. And last but not least, $195,000, $48,000 in reserves. For $195,000, you could acquire 10 properties. I mean, that's not pocket change, it's a lot of money. But what does $195,000 do for you? What will it do for you? Average cash flow on each property about $500 a month is what we're going to say. Annual cash flow on 10 properties equates to $60,000 an income. Right? So $195,000 investment just created a $60,000 income for the rest of your life. Leverage the bank's money to buy, leverage the renters to pay. You're making 30% return on your money. If you had scenarios like I just talked about, you're whole in 3.2 years. In 3.2 years, if you're making $60,000 a year, you recapture all the money that you just put in. Right? Now the ROI is exponential because you're whole again. And you just create an income for the rest of your life. So think about it. 20 years down the road, if you bought 10 properties, you'd have $1.2 million in income generated, and you'd have equity probably almost of, who knows, another $2 million, depending on, the appreciation. So you took a $195,000 investment and probably created $3 million for yourself, if not more, with $195,000, right? People ask me all the time, what happens after I get to 10? How can I keep going? How can I keep buying? I'm going to show you guys what to do now, what happens when we get to 10. For those that are only at property 1 or property 5 or property 0, if you're looking to do this as a full-time thing where you're going to essentially do this for the rest of your life, you probably will get to 10 properties. And I got investors that are well over, and they ask me all the time, what do I need to do? You have to consolidate and repeat, and I'm going to show you how to consolidate. To consolidate and repeat, you open up an S Corp or corporation. gotta be an S corp or corporation. No, it cannot be a sole proprietor, it cannot be a partnership, it cannot be an LLC. Do you guys understand the reasoning, the difference between the two? With a sole proprietor, partnership, or LLC, you're filing when you file taxes on that type of organization, you don't pay taxes on the entity. The income transfers over passively to your personal returns, and you pay the taxes from your personal liabilities. You get what they call a K-1 that transfers over. So this type of situation or company that you own, the liability becomes a personal liability, not a business liability, because it transfers over into your personal tax returns. And Fannie Mae says that if it transfers over to your personal returns where you have to pay taxes on it personally, with the K-1 that you get from these businesses, you then have to count those properties as a liability, and they count as finance properties up to the 10 mark. An S corp or a corporation are actual identities or companies that are completely separate from your own personal liability, completely separate. So Fannie Mae says if you have an S corp or corporation that these properties are deeded under, but not just that, the loan has to be under the S corp or corporation. I can exclude those properties from your personal 10 finance property pool and your debts. It's like they don't exist anymore personally. It's like
You can't do that with an LLC?
can't, because it passes through to your personal return. It's got to be an S corp or corporation.
That's what passes through as well.
Well, not all. And the corporation is the key. And I'm going to show you the next slide here where Fannie Mae says, not all S corps will carry over. It's anything that carries over to a personal liability where you're getting a K-1. That's where Fannie Mae has a problem. The S corporate corporations, corporation being the one that is probably the most viable, because a corporation absolutely, C corp, absolutely does not pass over. If you set one of those up and you do a blanket loan, which is the next thing here we're going to go over, you get a commercial wrap loan. I have a broker option where you can get a commercial wrap loan to wrap all the properties on one loan. So if you have 10 properties, you can put those 10 properties under one blanket loan through a broker option that I have, and you put it under a corporation. You want to do it under a corporation, and then you also deed it in the corporation, and then it doesn't exist.
Usually if your income's less than $1 million, it's better to put it in an S corp.
So here's my question. So once you have these 10 properties in a corporation or an S corp, and obviously this loan is going to be under that for all 10 properties, is part of the process, I mean, this might be too technical, but is part of the process on each deed, it has to change now?
It would. You would
Okay.
have, yes.
So you'd have to go back and change each deed?
Well, you do that in the loan process,
Okay.
because there would be, when you're getting a blanket loan, they're gonna do an appraisal on each
Right.
property,
Right.
and you're gonna be basically deeding it, all of it out into a corporation.
Okay, and then, once you have these 10 properties, what if you want to sell a couple of them down the road, and obviously just because of reasons, who knows?
Yeah, and then you'd have to get partial releases of lien, which you can do.
Okay.
So you'd have to get what they call a partial release of lien, because the liens are gonna be tied to all properties. You're gonna have like a $1 million lien that's gonna reflect on each of the title works of all the properties. Well, if the value can sustain, if you remove 2 of the properties, you could sell them, but you're gonna have to get what they call a partial release of lien to partially release that lien from that specific property, and it is doable.
This isn't, so that's secure or something that you have to go through the whole process.
Well, you'd have to-
Financing.
Well, no, because you have to just make sure that the blanket loan lender, which if you want to go that route, you just got to make sure that they're okay with, that there's a substantial enough equity to, in the other 7 or 8 properties, that they can do a partial release. It's not gonna, if it doesn't hurt you and you can sustain it, they'll allow you to sell.
So expensive.
You know, that would be something that I'd put you in contact with the broker if you are in that scenario, so they can give you more information on it. I don't personally do the blanket loans. I just broker those out. Okay? So in terms of the actual details of how much it cost, those types of things, I'll get you to the contact person that you need to talk to, if you're already at that place. If you're already at this.
So do you have to wait till you have to?
No, you don't. Good questions. You don't. Absolutely not. Most wrap loans, they do 5 loans. 5 properties is their minimum. And I think 350,000 is the amount.
Commercial loans for only 5 years.
You got it. You got it. You got it. Okay. So these are scenarios where the finance properties would count towards your 10 finance properties. Joint or total ownership of a property that is held in the name of a corporation or S corp, even if the borrower is the owner of a corporation. However, the financing is in the name of the borrower. Okay, you got to make sure that it's not in your name. Ownership of property that is held in the name of a limited liability company or partnership where the borrowers have an individual or combined ownership of 25% or more, regardless of the entity that is obligated on the mortgage. If you own more than 25% of an LLC and there's properties in that LLC, doesn't matter who holds the note. If they're financed, they count towards your 10 finance rule. Okay? And then the last one, ownership of property that is held in the name of an LLC or partnership where the borrowers have an individual or combined ownership in the LLC or partnership of less than 25%, but the financing is in the name of the borrower. And that's when it will count. Here are scenarios where it doesn't count. Ownership of a property that is held in the name of an LLC or partnership where the borrowers have an individual or combined ownership in an LLC that's less than 25%. So if you're involved in an LLC that owns 10 properties, but you only own 20% of it, I don't got to count those properties. If you own more than 25%, I got to count them.
So that would be a situation like you're a passive investor in a
That's right.
multifamily or something.
That's right. Yep, 25% is the magic number, right? If you're greater than that, you got to do what? You got to go ahead and get an S corp or C corp, because that way you can avoid it. But if it's an LLC, you got to have less than 25% ownership. Joint or total ownership of property that is held in the name of a corporation or S corp, even if the borrower is the owner of the corporation and the financing is in the name of the corporation or S corp. This is straight off the Fannie Mae handbook. S corp or corporation, they don't care how much you own. You can be the sole owner. And as long as the loan is under the S corp corporation, you don't have to count it. Okay? Last but not least, ownership of commercial real estate never counts towards finance properties.
Really?
Even if you have a loan and it's in your own individual name. Commercial property does not count. Okay? Yep. So, just to give you some stats, from last year to this last quarter, I did $376,000, 376 loans for a little bit over $51 million. Yeah, I mean, that just goes to show you how much business we actually do. This is just investor lending. It's not the other part of our business, which is a big part as well, which is the owner-occupied and primary residence purchases. This is just for investor loans that we've done in the last year and 3 months. So we know what we're doing. We're a small group. There's not. I have 2 offices, one in Houston, one here in Austin. We got about maybe 12 to 15 loan officers total. We don't have a big group, but we're very strong. We have a presence, and we know what we're doing. So, if you guys have any questions, my contact information is here. Write it down. It's also in each of individual folders. My number's in there, my card's in there. I would love to be able to individually help all you guys out. Andy's going to come up and talk to you guys about finding some deals and other things. And I think there's some real-time leads that they're also going to be in the back after the seminar. But I want to thank you guys so much for coming.